Hello and welcome to this video on all about IPO in stock market. An initial public offering, commonly known as an IPO, is the process by which a private company becomes a publicly traded company by offering its shares to the general public for the first time. In this video, we will be discussing everything you need to know about IPOs and how they work in the stock market. What is an IPO? An IPO, as mentioned earlier, is the process by which a private company becomes a publicly traded company by offering its shares to the general public for the first time. The company usually hires investment banks to underwrite the IPO and help with the process of selling shares to the public. Why do companies go for an IPO? Companies usually go public and offer IPOs for a variety of reasons. Firstly, it allows them to raise capital by selling shares to the public. This capital can be used for various purposes, such as expanding the business, paying off debt, or funding research and development. Secondly, going public increases the company's profile and visibility, which can help attract new customers, partners, and employees. Finally, going public also provides liquidity to the company's existing shareholders, who can sell their shares on the stock market. The IPO process. The IPO process typically involves several steps, including selecting an underwriter, preparing the prospectus, filing the registration statement with the SEC, setting the price and number of shares to be sold, and marketing the offering to potential investors. Once the IPO is launched, the shares are sold to investors through an auction process, and the company's shares begin trading on the stock exchange. Pros and cons of IPOs. While IPOs can provide companies with several benefits, such as access to capital and increased visibility, there are also some drawbacks. One of the main drawbacks is the cost of going public. The process of preparing for an IPO can be time-consuming and expensive, and companies may need to pay significant fees to underwriters and other advisors. Another potential downside is that going public may require companies to disclose sensitive information about their business, which could be used by competitors. Conclusion. In conclusion, an IPO can be an excellent way for a company to raise capital and become a publicly traded entity. However, companies need to weigh the costs and benefits carefully before deciding to go public. Investors should also do their due diligence before investing in an IPO to ensure that they understand the risks and potential rewards involved.